Thursday, December 29th, top of the hour, 1 p.m. Eastern time, 10 a.m. out there on the West Coast where Dan Nathan is. In just a few moments, we'll be joined by EY from SoFi, who is currently with the SDs on the IC. Just throwing that out there for you folks on the Twitter. This is, in fact, Market Call. Today's episode of Market Call brought to you by SoFi. Get your money right, Dan, all in one application. And, of course, our data partner and sponsor, FactSet, financial data and analytics that are powered by Tomorrow. Before we get started, I watched this thing on Paul Rabel last night, and Stephen Rafis, our guy Rafis, was really prominently displayed in that. Got a game ball late. The Cannons tweeted out a video of him. And I'm really shocked. I know you are as well, Dan, but Alexei Lafreniere is going to be a healthy scratch tonight in Tampa. I think that's the first time in his Ranger career. Clearly, Coach Gerard Gallant sending a message to his struggling 22-year-old. Back to you.
I mean, I'm speechless.
Yeah,
No, that was epic. You know, Guy, it's kind of funny. We just got off a call for Fast Money. Let's peel back a layer of the onion here. We do a 12:30 Eastern call in preparation for our 5 p.m. show. We talk to the producers, the host, the other panelists, that sort of thing. We come up with a couple ideas, things that we want to focus on. And without spoiling it, we are going to do the one chart that each one of us panelists is most focused on for 2023. But here's one chart today. Okay, today that you got to keep an eye on. Look at the day chart in Tesla. Okay, and listen, we talked about it last night on Fast Money, and I think I said, and I think you agreed. I think this stock is obviously ready. It's going to rip at some point, right? If you think about how much it's kind of been pushed down in such a short period of time, I think it had been cut in half just in the last month and a half or so. So you had this huge gap today, up 7-8% or something like that. Well, we're well off the highs. So this is one for today in a rip-roaring market. Don't you want to keep a close eye on, Guy? If it starts to fill in that gap, do you think it could take the entire NASDAQ with it?
No bueno, without question. It reminds me of that 1986 Beastie Boys album, License to Ill. You got to fight for your right to party. Yeah. And Tesla currently is fighting for its right to party, but it ain't working out now in the back half of the day. And to your point, on a serious note, given the last couple of weeks, the sell-off in that stock, a precipitous sell-off, having sold off for months prior, if this stock can't hold today's bounce on the back of an upgrade, on the back of, again, this ridiculous sell-off over the last couple of weeks, that's not good, and that's telling you something. And, oh, by the way, it's probably potentially going to do it on a decent amount of volume as well. So I think you're right to start the show with this because, to your point, I don't know if it takes the entire NASDAQ down with it, but as we've mentioned a number of times, it is clearly a sentiment stock for the broader market.
Yeah, and listen, and it could hold right here, and it could close at the highs.
No,
and the NASDAQ,
but you have to watch, Dan.
Yeah, and the NASDAQ that's up 2.5% today. If it were to make a new high, the NASDAQ's closing up more than 3% on the day because the broad-based strength is pretty astounding. And again, we talked about this yesterday. It's like the sell-off in most stocks over the last couple of weeks felt orderly. Now, it did not feel orderly in Tesla over the last, let's call it, couple weeks. Maybe Apple felt a little panicky over the last week, but today's buying, Guy, feels what? Feels like what?
Well, I'm glad you brought that up because as we mentioned a number of times, outside of potentially 2 days this year, and I would say probably the June 15th low, I think it was around there, and the October 13th, 14th lows, which were definitely felt panicky on the sell side, I would say the other 80% of the time that we moved in a market fashion, the panic was to the upside. And I think that's exactly what you're seeing. People are panicked to get in. Oh, I don't want to miss it. I'm going to miss it. And I think that's exactly what you're seeing. But to your point, what are we trading, like 119 right now? You know, if it starts to give it up in a meaningful fashion, if this were to close, even if it were to close around 113, 114, I would say that's not a particularly strong day.
Yeah, so let's talk about another thing that's deflating right now, and that's the VIX. And I think we
ego.
have well, hey, come on, buddy. The VIX right now is a really interesting setup. And I think you and I are in agreement. I think we talked about it on Market Call that, everybody was hoping for this kind of year-end rally over the last, few weeks. And the fact that we've just kind of fallen off a cliff in the last few weeks, I guess it was like one of the worst Decembers on history. We have the NASDAQ 100 down a little more than 8%, the S&P down, 5.5%. This is after today's 2% gain in the S&P and 2.5% and the NASDAQ. Look at that VIX, okay? And again, this is Rayfus. He's probably using his right hand on this chart here, not lining up, the points exactly where we want, guy. But if this thing breaks 20 to the downside into year end, I mean, I got to tell you, it's setting up to buy premium for directional sort of shorts in a really nice way, especially if it just gets smushed over the next week and a half over the holidays. Thoughts there on that? Because when you look at the S&P, we've talked about that rotation into value, into defensive sort of names, which has shown relative outperformance versus the NASDAQ. But the VIX could be telling you something here where it's setting up very soon for a great sale of equities.
Yeah, I agree with that. And I think to your point, it gives you an opportunity to be long volatility. Also, though, take this into consideration. There are obviously a lot of people out there that sell upside calls against positions or stuff. Yeah. But I would submit, and again, I understand that volatility to a certain extent is stock specific too, but I'm drawing in a broad brush. If the VIX were to get down to those levels, I don't think you're going to get paid enough to sell those upside calls. I think you're more inclined to buy that volatility potentially directionally for a bet. And I think that's exactly right. Or, it gets into the high teens. You're saying to yourself, every time we've seen the VIX down in the high teens, that's been the opportunity to sell out of long positions or stocks and potentially take short positions as well. That's how I got to look at it. And I think that's why we try to bring it up. Not saying you're trading the VIX, but you're using it as somewhat of a barometer.
Yeah. So days like today, guy, again,
29th of December.
Yeah, well, it is. Does it shake you out of, let's say, your bearish near-term conviction when you see a sort of rally like this on the penultimate day of the trading year? You see what I did there? Penultimate.
I like that. Nice job.
That's a word I think that you would use. I'm surprised you didn't lead us out of this program.
Well, I'm happy you brought that up. That's a Melissa Lee word. Karen Finnerman uses that from time to time. I will use it on occasion, but that's not my go-to. I have a lot of go-tos. It's interesting now that you've led me down this road. We have to bring EY in from SoFi in a second, but everybody in our line of work has their verbal crutch, and once you sort of hone in on it, you can't help but hearing it. So if you were to listen to a lot of talk radio, especially sports, the amount of you get over the course of a 7-minute interview is staggering. Yeah. So once you've tuned your brain to hear it, you can't hear anything else. Anyway, I'm sorry.
Yeah, but wait,
I mentioned that because there's a show that we watch in the morning that has become, for that very reason,
and when we come back, what?
Anyway,
all right,
back to you.
So here's the deal. So the question was, it's the penultimate trading day of this year. We're likely to close in bear market territory, which is, again, doesn't really mean anything, down 20% from the highs or so. Does a day like today, light volume into a holiday, we know Monday's off, all that sort of stuff, does it shake you out of your bearish convictions? Because we had a really interesting conversation with Mark Zandi. He's an economist. He was on Fast Money last night. I don't know what he had to say.
You're really just trying to tune me up before we get to Liz.
I am trying to tee you up a little bit. A really interesting conversation with him, but he was saying that the consensus among economists that we're definitely going into a recession next year is kind of dangerous, right? And he doesn't see why that's happening. Why is that consensus building? And we've talked about that a little bit on Market Call of late. We're saying that, listen, the economy feels okay. We have unemployment at 3.7%. That's where Zandy, I think, had a little zinger, Zandy's zingers. If we were going to have him as a regular on Market Call, maybe it would just be a segment called Zandy's zingers.
I like that.
Like that. So his point is that the economy's actually doing okay. Unemployment's here. Maybe we're coming out. Thoughts there, Guy?
Well, yes, and thank you for that, because as they said in the movie Fast Times at Ridgemont High, Damone said it. I woke up in such a good mood, and I did. And now you've done something. I'm going to get in a bad mood here, but it's what I can't, because EY is about to come on, and we haven't seen her. But I'll say this: my point is to him was, and I've said this a number of times, I don't know what difference it makes if we've been in one, are in one currently, or going into one. I don't know what necessarily changes. And then the point that I made for emphasis is, for 12% of the population, they wish we were in a recession because it's worse for them than just a mere recession. What we try to focus on is not economics and not the definition of things. It's how it's going to impact the market. And I will tell you, in terms of earnings, I guarantee we're going into a bit of an earnings. Well, I shouldn't guarantee anything, but
yeah,
we certainly feel like we're going into an earnings recession. You know, what that means for the economy, I really don't know.
Yeah, you know what? Here's a good one. And our friend Doug Cass, Seabreeze Capital, and
Love
he writes
Doug.
on Real Money, and he just put out this week his 10 surprises. I actually have been reading this for a very long time.
He's usually pretty accurate.
No, he nails a lot of stuff. There's some good stuff in there. One of them, interest rates and inflation plummet in early 2023 and then rapidly climb in the last 6 months of the year. Again, what I love about lists like Doug's is that it kind of tests some of those consensus sort of views. So he's saying that, okay, maybe rates do continue their downward trajectory. Maybe inflation, all the readings that we talked about. And this actually lines up with what you've been saying, Guy. You know what I mean? He's also has some predictions about what happens in China and that sort of thing. But then you see inflation and rates start to go up in the back half of the year. That is out of consensus. That is the thing that would actually make sure that the stock market closes down for its second consecutive year, which it has not done. And we talked about this on Market Call earlier. We're going to talk about it with Danny Moses on the tape when we record later this afternoon for our last episode of that fine podcast of the year.
2 years, like,
but think about this. We've been saying this. It's like, man, you know, maybe this has more like a 2000 to 2003 setup than the 2008 analog, where we just had that one really bad year in 2008. Things were a little rocky in 2009 in the beginning, and then we rally out of it. So a protracted recession, a rolling sort of economic, you know what I mean, malaise over the globe, if you will. You know, maybe COVID, it just sticks around. It just kind of continues to kind of disrupt supply chains and the like, that sort of thing. And maybe it's just going to take us 2 or 3 years to get out of this, Guy.
You know, it's interesting because when David Tepper was on the network a couple of weeks ago, he actually, everybody's looking again for the parallels and the correlations between, you know, past bear markets or just sort of past phases we've been through in the economy. Yeah. He actually mentioned exactly that 03 period that a lot of people don't talk about. And what he mentioned specifically was what happened to valuations, what happened to the multiple people who were paying for the S&P 500. It actually troughed, I think, down to 11 or 12. And he said, again, he was not suggesting we're going there, but it has happened before. So I think it's smart of you to point that out.
But you know, and the last thing I'll just say in kind of bookending this conversation is that this is why Tesla, to me, for those of you who are like 400 to 100, it's an unusual value. I'd say that it's been mispriced the whole way up in 2020, 2021. It just started coming undone. And the way in which it came undone, I said this on Fast Money last night. I mean, this is the largest market cap wreck in the shortest period of time in the history of the stock market. And when you think about it, with a $350 billion market cap, and estimates are coming down. You saw Adam Jonas on Morgan Stanley year over year. He's expecting earnings to come down. And we have had Dan Benton on the podcast, on the tape, and OK Computer a couple times this year, and we went back to his 20 rules of tech investing. And number 1 was sell them right when estimates are coming down, and number 20 was see number 1 again.
Yep.
And that's what's happening for the first time in Tesla at a time where investors are really concerned about valuation. So this stock may rally, but it may go much lower.
The rallies, I think, are going to be muted, and now a lot of people are coming around to that line of thinking. And you're right, the market cap destruction is interesting. By the way, Amazon's lost $1 trillion in market cap. I think that's the first company in history. I mean, we talk about companies that get to $1 trillion. I think at one point Amazon was 1.8, 1.9 trillion, and that's dipped about, last I looked, at least yesterday, was about 800 or so billion dollars. I mean, it's remarkable. Nobody talks about Amazon. We do, but Amazon is making multi-year low right before our very eyes. If I were to go out in Times Square, not today because I'm not there, but on any given day, and ask 100 people, what they thought of Amazon stock, they will all think it's the greatest stock to own of all time. It's one of the worst stocks you could have owned over the last 4 years, which is really interesting when you think about it, Dan Nathan.
Matter of fact. All right,
I like when you say matter of fact. It is matter of fact. Do we bring her in or no?
Yeah, let's do it. Just, so matter of fact is one of my things. Oh, by the way, is one of your things.
I do all the time.
And people don't realize this, that, it used to be, and just, I saw Lester Holt in a restaurant the other night, like Lester Holt. Back in the day, if Lester Holt had one of those crutches, he doesn't see it because he doesn't have social media. He doesn't have an email that people can get to. But now we have people literally tweeting at us, dude, you just said this for the 3rd time in the show, and we're seeing it right away. And it gets under your skin a little bit, doesn't it?
I understand. I do the oh, by the ways because I like to emphasize. And oh, by the way, coming to us from parts unknown, EY from SoFi. Oh, look at that. Very festive. Where are you?
Can you hear me? I mean,
Yeah,
I didn't get to
course.
test anything. I'm at the
We can hear
NYSE,
you.
obviously. Look at.
Oh,
wow.
well, look at
I have
that.
this
It just says
dynamic
YSC
background.
to me.
Well, I don't know how to turn the screens off, so they're going to move like this the whole time. I apologize to everybody
I
for
love
the
it.
distraction.
Hey, LY, just so you know, in the new year, we're hoping that you will do market call with us in our fine new studios.
No way.
I would love to.
And that would be amazing.
IRL.
But
we're going to do it IRL.
IRL. But you look great in that backdrop there. And Guy just
Thank you.
He basically teased that you're going to be coming on. And I don't understand what he was getting at.
Well,
he said
currently
she's on with the SDs and the IC. That's what he said.
I said currently EY is with the SDs on the IC, and that's probably.
I was on half today.
Yeah.
Steps away from here. So I'm all warmed up. I'm ready for this. By the way, my crutch words. I start a sentence with well. And if I don't know what I'm going to say, now everybody will know this. This is the secret when you're watching. If I'm not quite sure what I'm going to say yet and I'm trying to get my thoughts together, I say something like, here's the really important thing I want people to remember. And I buy myself like 5 seconds.
And you actually named your podcast that's on the SoFi podcast.
Why do you think it's called that?
The important part. So she knows that. All right. So here's a couple things, Liz. We want to run through a whole host of things that were on our docket, but you also had your 2023, kind of like piece out, your big, forecast piece. You did a little review of 2022. It's on the SoFi blog. It's great. We'll put it in the show notes for you listeners. Jacob will tweet it out and we will retweet it. And it's great. We got a bunch of your charts here, but let's talk a little bit. I don't know if you could hear us before. We're just talking about a day like today. It's just an orgy of buying. You know what I mean? And it comes after a pretty nasty couple weeks. What do you make of a day like today, a holiday shortened week? Thoughts in just general as we kind of finish out the year here?
Well, I mean, I think it's relief. It's relief from the down days that we've had. Look, here's the thing. Like, think about the month of December. Before today, we were down 7.3% in the S&P. That's terrible for a month that everybody said we were going to have this year-end rally, and there were these seasonality tailwinds at our back, and we're down 7.3% coming into today. If you were doing any tax loss harvesting, yesterday was really kind of the last day you could sell in order to get it to settle by the end of the year. So now maybe today there's just a little relief, I don't know, repositioning for the beginning of next year. But I think the really scary part about this is that we didn't have that year-end rally. And this last 2 days isn't going to make up for 7.3% negative. The sentiment that we're seeing, and I just said this on half, the sentiment that we're seeing doesn't care that the calendar is going to change from December 31st to January 1st. It's still here and it's still bearish. I'm tired of talking about bearish sentiment, but the reality is that it's still here and we're not done with it yet.
I hope you told the Youngs that I wished them my best for the holiday season. I know you did, by the way, because I could see by the chuckle.
I tell everybody that.
Of course. I appreciate that. Now that we're at the, as Dan mentioned, penultimate day of the trading year, it's good to look at annual returns because you can look at basically what we're looking at. And you brought with you a great little graph that illustrates exactly this, EY.
Yeah. Are we talking about the stock and bonds together?
Annual total returns.
So this is only the fifth time. And I don't know if people realize how unique this year was. This is only the fifth time since 1928 that stocks and bonds have both been negative. And if you look at this chart, it's the worst one. Right? I mean, stocks have been more negative than this before, but bonds have not been more negative at the same time. So this was a bad year. And I will say this, writing an outlook, I do one for the beginning of the year and then I do one mid-year. The outlooks I wrote for 2022 just rolled off my fingertips, not because I knew what was going to happen. There's certainly things about them that were wrong when I look back at them. But it was pretty clear that we were heading into a tough environment for stocks, a tough environment for bonds, and that we were changing the regime from easy to tight. That all was pretty clear to all of us. And even the mid-year outlook was easy for me to write. This one for 2023 was really tough because I don't think that there's good consensus around what's going to happen, even if we do have a recession. And I was thinking about this just earlier today. Even if we find out we're in a recession, let's say stocks bottom in January, and I think that there's a decent chance we have a pretty big stab down in January. If they bottom in January, that still means the recession either is just starting or hasn't yet started. We find out maybe 6 months in that we're in a recession. The average recession lasts 12 to 18 months, which means that by the time we find out we're in it, we might still have 6 to 12 months to go. So to the point that you guys were making earlier in the show, what if this is another year of just kind of trudging along and we don't actually make a ton of progress and this drags out?
Yeah, I think that's a really important point. And you have a chart, maybe they can throw it up here about recessions and the cycles and kind of when, markets start anticipating when they're going to happen. And again, markets bottom. I think the likelihood that the stock market bottoms in the first quarter of this year is like wishful thinking here. And again, because what's gone on over the last couple of weeks, just the wholesale selling of high valuation stocks that are seeing decelerating growth because interest rates ticked up. If you think about it, I mean, that's a large part of it, in my opinion here, is one that it's not going to correct itself in a matter of weeks or months. It's going to be probably quarters. And I think that investors should probably consider, listen, there's going to be some great opportunities to pick stocks, the sort of rallies that we've talked about. And, over the course of this year, the one from June to mid August, the one from October to, early December, those sorts of things. I mean, those are great trading opportunities. I think the hard part, and Liz, talk to us a little bit about this, because, you speak to an audience that are not traders. We're Guy and I on a show called Fast Money. I mean, we've been trading, for the better parts of our careers, looking for these inflection points and these opportunities, not taking 2 to 3 year time horizons. We can speak to that and we can talk to that, but talk to us about this cycle, this pattern of cycles that you mentioned, how markets usually trade in and around recessions, but why this time might be different, because the recession we had in 2020 was, as Guy would say, alchemied out by $4 trillion of fiscal and monetary. And then if you think back to 2008, we only had one down year on the stock market. Why? Because we started all of that easy money stuff or whatever. So now we're on the other side of that. And again, this is why I think, Doug Cass's point that we just highlighted before in one of his potential surprises is that if rates actually go higher from where they are right now in December over the course of next year, that's going to be horrible for risk assets across the board. And those kind of trough multiples that Guy was talking about, that Tepper talked about on CNBC last week, they may come true. We may see low teens multiples for stocks. So talk to us a little bit about that.
Yeah, so I don't know that we would get that far down in multiples, because I still think that there's a pretty big downward revision coming in earnings. So if the E goes down, I don't think that the multiple quite gets down to that level. However, if you're comparing to previous recessions, and I'd call my show slow money. You guys can be fast money. I'll be slow money. If we're comparing to previous recessions, the 2020 recession was so fast, so furious, and then it was over in the snap of a finger. That's obviously not something that's going to happen this time. The 2008 recession, and I would invite both of you to argue with me on this, but the 2008 recession was due in large part to excessive risk taking in parts of financial markets. And there was a structural issue that occurred that then basically took the system down. Now, of course, there's been excessive risk taking in financial markets this time around because rates were so low and we saw those lofty valuations. But I think we've gotten rid of a decent amount of that excess in valuations. And if we have a recession in 2023, it will be induced by Fed rate hikes and inflation, which is maybe a structural issue in the economy, but not a structural issue in capital markets. So I would hope, I know hope is not a strategy, but I would hope that if we do have a recession there, because we've done a decent amount of work on that excessive side, that it doesn't last quite as long and we can get some of the economic pieces back in balance and go on our merry way. Now, that doesn't mean it's going to be over in 30 days, because I do think it would take a while to really get there. The other thing that could change a lot of this trajectory, and I said this just today on Half as well, is that the Fed projections are based on basically a linear pattern. So they assume that inflation is going to come down in a linear pattern, economic data is going to come down, the unemployment rate is going to go up in a linear fashion. They can't bake in something like a recession. So there is not a recession baked into what they say they're going to do and what their projections are for the economy. If one occurs, what it's going to do is pull forward their entire reaction function. And then that changes the way capital markets respond.
She invited a debate, so I will accept that invitation. I will say there are a few Catholics out there. You'll hear your priest often say there are no straight lines, and I think that's exactly what you speak of. I will say this, though. You're right. 0809 was on the back of excessive risk-taking, without question. The problem I have, and I'm not suggesting I'm right, but that risk never went away. It was just moved. It was moved from the balance sheets of banks to the balance sheet of the Federal Reserve. And now you have a Federal Reserve, which at its max got close to $10 trillion in terms of their balance sheet. And now they're trying to quietly unwind, and money supply continues to go lower. Fed's trying to unwind their balance sheet. There are ramifications. Now, maybe they can thread that needle, and maybe they are, in fact, the greatest prop traders in history. I don't think they are. So although the risk appears to have gone away, it was just cleverly moved. Dan, Nathan, back to you.
Matter of fact, this was a really great chart that you had in your outlook, Liz. It was mapping since June 30th, the S&P 500 sector total returns. And this one, again, no surprise here, energy up nearly 20%, industrials up about 13%, materials up about 8%, financials up nearly 8%. And then on the flip side, communications down 13%, real estate down 7.3%, discretionary down low single digits. Those are the three sectors that were down. Let's talk about what we expect for 2023 to maybe, outperform again, because I think that a lot of investors who've kind of been through these past kind of recessionary and bear market cycles also recognize, a guy is one of them. He's raising his hand there.
No, I was going to just quickly raise my hand, and I apologize for this, but
yeah.
So I look at this S&P 500 sector total returns since June 30th. And then for you folks out there, you'll know that Spotify apparently at the end of the year sends you your year-end in review, and we're going to
wrapped.
Wrap, they call that?
They call it wrapped. Yeah,
right.
Wrapped.
And although I knew this intuitively, they actually had it for me in a quantitative form. I'm in the top 0.5% of all Led Zeppelin fans in the world, which I think is great. So I look at all of this. I think Spotify. I think Led Zeppelin. Let's see if there's a clever person in the comment section. But I look to the far right, and what I see is, wait for it, a communication breakdown.
Ooh, there we go.
Oh dear.
Just so you know, hey Liz,
we waited a long time for that.
Liz, I was in a car the other day. I was in my in-laws in Dallas, and
so
I go to FM radio, I go to a classic rock channel, and I literally communication breakdown, Led Zeppelin, Hey You by Pink Floyd, and then there was Gimme Shelter by the Rolling Stones. I took a screenshot. I went to their website and I took a screenshot. I sent it to Guy, and I was like, this is like, for you, FM radio is where it still lives in your head, right? Like that was like the time in which you were probably at your hottest, you know what I mean? But like, think about that. If you're that DJ, and that's the job that if Guy could retire to, I think he'd love to just spin vinyl. Yeah. But that was like epic, and I was like, God, I miss kind of FM radio and just the chance of what might come on. All right, real quickly, back to this S&P 500 total returns since June 30th. Okay. So Liz.
Well, first of all, go ahead.
No, well, we've talked about this. John Butters, our friend at FactSet, who writes the Earnings Insight blog, he's talked about the contribution to S&P earnings. Without energy this year, we would have been down, okay? And we've talked about, estimates for 2023 S&P earnings are still expected to be up 5 or 6% or so. So we haven't had that revision that you just spoke to. And energy is supposed to trail off to some degree, I think in like mid second quarter to Q3. So at some point, if we're not going to have an earnings recession, we're going to have some other sectors kind of step in there and show some leadership. So what would those sectors be? And just give us your thought of why you included this chart into your 2023 outlook.
So the reason I started it at the end of June is because that's when inflation peaked. So we wanted to see, what did the market do? What kind of patterns did it show, if any, after inflation peaked? And it sent a lot of mixed messages. So you're going to see things like cyclicals in some of the best performing sectors, which meant that the market wanted to believe that we were getting there. And then you see some of those growthy things in the worst performing sectors. But interestingly, tech wasn't even negative. So the market was confused. And to quote, I believe, Jennifer Garner, she gave a commencement speech at a university, and she was telling the students that in dating, mixed messages means no. I would say the same thing about the market. Mixed messages means no. We're not going to make a new rally. It's not a durable rally. We're not in the new uptrend. So get over it. And I think we're continuing to send some of these mixed messages. In 2023, if we have a recession and we come back out of it, I know Dan disagrees with me on this, but I'm not a big believer that tech is going to be the darling of that recovery. It doesn't mean they're going to do poorly, but I do think that, and you'll see a section in my outlook about this, you go back to something like Fama French, which hasn't worked admittedly in 2 decades, but I think it could start to work again. Things like value over growth, small over big, some of those classic cyclical sectors, because if this recession occurs, it's going to be what I would call a more classic recession, where we flush the economy, we flush the market, and then the recovery on the other side should be more classic as well.
First time in the history of Market Call that the name Jennifer Garner was thrown out there.
I did not plan that. I don't know where that came. I just
by the way,
file cabinet.
Yeah, Ben Affleck really whiffed on. I mean, I think listen, that's just me. I'm a big Jennifer Garner fan. She's in, by the way, you can't look at a TV right now. She's on like 7 different commercials, but that's neither here nor there. And by the way, somebody said they can see your next piece when you title it having some sort of Zeppelin reference, perhaps In Through the Outdoor, but I digress. Earnings estimates for 2023. That's the next little slide that you brought with us today.
Yeah. So, okay. Earnings estimates for 2023. Now, yes, they've come down. They've been revised downward by about 11%, but they're still showing year over year flat growth. I don't think that's how it's going to end. I think the story ends with 2023 showing a contraction of at least 5 to 10%. And I think we start to hear about those contractions, or at least estimates of those contractions, in January, when all the analysts come back from vacation and get honest with themselves. So I think we'll end up seeing a contraction in earnings. The earlier we hear about that, the earlier it hits the market, which is why I'm more in the camp of, I think we could see a pretty painful first quarter, maybe even first month.
Yeah, no, and again, I listen, we all want to be optimists. We all want to kind of hope that we don't have the worst case scenarios for the economy. I mean, we've been going back and forth between this final piece of the Fed's puzzle that they'd like to see, sadly, unemployment tick up, right? You know, it's at 3.7%. The pre-pandemic low, which was a 40-year low, was 3.5%. And that's the one thing that the housing market the jobs market is still really, really tight. And then I'll just throw in the housing market, to see the housing market come in. Again, these are things that would weigh on household incomes, household savings, you know what I mean? Like all that stuff at a time where guys brought this up on many occasions over the last few months, where consumer credit is going nuts at a time where interest rates are not coming down that much anytime soon. So we could find ourselves in, to your point, that the average recession, it's not a 3-month thing or 4-month thing like we had. I mean, obviously, by definition, a recession is 2 negative quarters of GDP. But if the 2000 to 2003 period tells us anything, is that you can have the recession, you won't know that you're in it until after the fact, and then they can go much longer than many people think. All right, your point, Liz, though, about what leads us out, okay? And we highlighted Dan Loeb, a Third Point, I think it was the other day guy, what he was saying on a tweet that, people hoping, that the prior leaders are going to be the leaders in the next bull cycle that lead us out is not a great case. And I'd love to get both of your guys' take on this. I just don't see how you have 5 or 6 stocks that are all $1 trillion or north of $1 trillion, some $2 trillion or whatever, that are not part of the leadership when the S&P and the NASDAQ finally bottom here. Because in my mind, it just doesn't, you're not going to have the earnings contribution of all these other groups, especially when it goes back to energy, very likely moderating as a contributor. You know what I mean? So those massive names with these huge moats, these monopolies, these massive balance sheets, all that sort of stuff, they kind of have to be the leaders, in my opinion, by definition. So Liz, curious is like, if you wanted to focus on a couple sectors where you would start picking at when things feel really ugly early next year, in your opinion, what would those sectors be that will likely emerge as the leaders, let's say, in the back half of 2023 into 2024?
Yeah, well, I mean, this will be no surprise. I would pick at financials. I would pick at industrials. My final trade on halftime almost a month ago, December 1st, was to sell consumer discretionary. I still think that, but if and when the market really pulls back, that's when you start to buy consumer discretionary. I'd also think about buying semis in that environment, but these are classically cyclical sectors and industry groups. So when you get that opportunity, that's what I would do. This is in the outlook as well. On average, 12 months out from a market bottom or in a recessionary environment, the S&P is up 49%. I agree with you, Dan. We probably can't get up 49% without some of those big cap tech names. I think they can take part in it. I just think that when we look back at the recovery and you see a line chart of here were the top 3 sectors, right? I don't know that tech is going to be one of the top. It might be okay in the middle. And given the size and the weight of a lot of those names in the index, it'll still kind of carry its load. But I don't think that it's going to be the standout performer. This isn't a a stay-at-home versus a re-entry sort of recession, right? And that's a lot of what drove tech the first time around. And it was also younger investors that were interested in those sectors and familiar with it, and they bought a lot of it too. That's just not what we're going to have this time.
Couple things. If I'm looking at 2023, when price to sales gets reasonable, which they will, I think a lot of these cloud, a lot of these software stocks, I think are going to be really interesting again. They've been taken out to the woodshed. I think they'll come out of the woodshed sometime next year, number one. Pull Liz's recession scenario slide. And as we do that, I'll say a couple things. I would have gone with Carry That Weight. Of course, a Beatles song for you Beatles aficionados out there. And when you use the word reentry, it immediately made me think of a scene in the movie Moonraker, a James Bond movie, but proper decorum prohibits me from explaining how they integrated that into said movie.
Integrated. Hey, Guy, really quickly, if they could pull up the IGV chart. Okay, so this is the iShares expanded software. And if you look at some of the holdings, this thing traded 450 at its high last year. It's trading just above 250. It traded a little bit below there, but it's really kind of hanging in there, Guy. And so, one of the things, if you look at some of the largest components of it, I mean, you know what they are here. It's the Microsoft, it's Adobe, Salesforce, Oracle. Oracle has been, that was the O in your Hope trade, wasn't it, Guy?
2 years ago, which, by the way, was extraordinary performance, if you remember.
It really was. That stock, Oracle, is only down 5% on the year. Microsoft down 28% on the year. It's besting the NASDAQ. Adobe has had a tough go, down 40% of the year. Salesforce has been an absolute disaster, down about 50% of the year. But to your point, I mean, I think that those, from a secular standpoint, those are trades that you're going to want to be back in, but you have to see those price to sales multiples trough a bit, and they haven't done that yet. If we could pull that chart out to a 5-year, I mean, I think that relative strength of the last couple of months is okay, not when you include the move off of the lows, but on a 5-year basis, Guy, it's hanging out right above those pre-pandemic highs or so. It feels like there's kind of another leg lower again. The technicals in almost every sector in the market suggest that there's probably another leg. No, nothing looks totally washed out at this point. Thoughts on that, Guy?
Agreed. I think that's exactly what I'm talking about. You've seen this sort of, they're flattening out, they're plateauing at these levels, but there's probably another leg. And that next leg is where you're going to get the opportunity to buy these stocks at a more reasonable valuation in the form of price to sales. By the way, I don't know if Stephen can do this or Jacob. Arthur Magazu, great little comment here in the section. If you can just pull it up. This sort of explains my use of Moonraker in the set. There you go, for you folks playing at home.
You know what? And we're not, because Liz, this is a PG-rated show here.
I was going to say, it's not a family show. I mean, as long as we disclose that, I suppose.
It's the penultimate day of the
Guy
year.
is not a family host.
So Liz,
I think Dan and I are decently family-friendly.
Well, you know what? Because Dan's from upstate New York, and you're from the Midwest. I'm sort of from,
Correct.
I'm from the rough and tumble areas of New York, and so I have a little bit more of an edge to myself.
I see.
Yeah, a little bit.
Okay.
All right, Liz, let's give Liz the final word. I just want to say this, Guy. I think you would echo this. Liz has been a phenomenal partner and contributor to us at Risk Reversal Media all year long. She's come on our podcast On the Tape. She's been here with Market Call with us every week, providing her fine work that you guys could find on the SoFi blog here a little bit. So thanks to you, Liz, for this year. It's been fun collaborating with you. And also, we're going to see you a bit more on the Tape. We're going to be doing a special Monday, a setup for the week that's going to drop in the podcast. So yeah, that's happening, Guy. Yeah, we haven't put that in your calendar yet because we know that Mondays, it takes you a little while to get going. I
wish I had it here.
Oh, he's getting his Filofax out, Liz. But but listen, thank you, Liz. We appreciate it. Thoughts on into New Year's Eve? Because you're a big
put it in there.
Wait, what's that? A Filofax. It's amazing.
Yeah.
Thoughts on what goes on in Liz Young's New Year's Eve celebration in New York City?
I mean, it's Scott just asked me if I was going to go to Times Square. I mean, he was kidding, but no, I'm not going to Times Square. I don't know what I'm going to do for New Year's Eve. I mean, I usually make it to midnight. I'm feeling this year like I'm going to make it to midnight. I'd be pretty proud of that. But I turned 40 this year. Sleep is important.
What?
Whoa.
And I want to rest up. Third.
Incredible.
got my own birthday wrong. The third, Dan, is the third. But I think 2023 is going to be another big adventure for all investors. And I look forward to doing more with you guys to talk about that adventure. I hope everybody that's watching is okay with this voice, because you're going to hear a lot more of it.
Whole hell of a lot more of it.
2023. Yeah.
By the way,
thank you guys
David
so much
Wilson,
for everything that you've done for me as well. I love doing this show. I love working with you. I love our audience. It's fun.
You have more fun doing this in 30 seconds. Just your intro is more fun than what you do with the SDs on the IC, but I digress. David Wilson saying, Guy, have you watched second season of White Lotus? I have. Really? Filmed in Sicily at the San Domenico Palace. Spectacular. I encourage you all to visit. Dan, Nathan, EY from SoFi. Are we closing out here, Dan, or you want me to continue?
I think I actually think that let's do a proper closeout for the podcast version of this that Jacob's going to put in the audio store.
Okay.
We're going to cut out that last 3 minutes of meandering stuff. So I'm going to start it over again. Watch this. Okay. All right. Well, that was a lot. We covered a lot. We got Liz's 2023 outlook that you can find on the SoFi blog. We're going to put it in the show notes. Also, thanks to Liz for all her fabulous contributions to Risk Social Media over the course of 2022. We look forward to doing more with you on the tape, more with you on Market Call in the new year. Guy Adami, you've been a stalwart. I mean, like literally, it's too bad the @stalwart is taken on Twitter, because I think that should be you. And that's our friend Joe Wiesenthal from Bloomberg. But Guy, you were here all year long. You were here and you did it. So kudos to you, as you like to say.
Like Gibraltar, like that, right? The Prudential thing, like just a big rock, solid. Yeah. You know, I like to think that. And I want to thank EY from we goof around, but I think the world of you, not only in terms of the work you do, which is second to none, but you as an individual. It's been great this year, and it's going to be fun, as Dan said, IRL, in real life, right? That's what that means?
That's what it means.
Yeah. Next year. Get your Beastie Boys album, by the way, License to Thrill or Ill or something. But that's it for Market Call on December 29th. I want to thank our sponsors, SoFi, Dan. Get your money right, all in one application. Of course, FactSet. There are not only our sponsor, but our data provider. Financial data and analytics, Dan, that are powered by tomorrow. Please watch the Rangers in Tampa tonight with Alex Lafreniere, who's going to be sitting in the press box for the first time. That's a message not only to Alex, but to the entire team. Like, you got to get your shit together here as we turn the calendar over to 2023. Packers getting 3.5 this weekend. You don't often see that. It's an unfortunate season. They're really falling on hard times out there. The Bucks lost a big lead last night. I mean, crazy. They're up 8 late, and they gave it up, which is not good. As I mentioned earlier, probably going to have to make a trade at the deadline. Brewers, I like their staff, but position-wise, I think they're in trouble.
What are you doing to me? What are you doing to me?
That's it.
Yeah. Okay. Thanks.
Right,
love you guys.
All right, Liz. Thanks so much. Happy New Year. All right. See you guys.
Bye.
See you.